Well, hello and a very warm welcome to this Scope Ratings webinar, Outlook for European Commercial Mortgage-Backed Securities. My name is Keith Mullin, and it's my pleasure to be hosting today's session, which is, of course, very timely, given that the commercial property market has been under the spotlight since the pandemic outbreak and the working from home phenomenon, and also because of factors that were in play prior to the pandemic. I'm delighted to be joined today by Florent Albert, from Scope's Structured Finance team. In a moment, Florent will take you through a presentation which will cover the revival of the European CMBS market, structuring and pricing trends, as well as financial metrics and rating levels, including, importantly, the wave of downgrades by US rating agencies. After the presentation, Florent will be happy to answer any questions you may have. To ask a question, simply go to the right-hand side of your screen. There's a questions function there. Type the question in, and once we've finished with the presentation, we'll be happy to answer questions. If there are questions for which we need data that's not immediately available, we will circle back to the questioner one-on-one to answer the question. Before the session closes, we'll be asking you to fill in a feedback form, which if you could download, and it'll take probably less than 30 seconds to fill in, that would be immensely helpful to us. It helps us, just create and sculpt better content for you in the market. So that's it from me. I'm delighted now to hand the floor over to Florent for the presentation. Florent, the floor is yours.
Hi, Keith. Thank you for the introduction. Hello, everybody. As an introduction, I'm a director in the structured finance team of Scope Ratings, and I'm overseeing the part of the CMBS CRE activity in Europe for Scope Ratings. So today's presentation will be focusing on the European CMBS market. We are going to go through a couple of slides. 1 and 2 will be on the revival of the CMBS market in Europe, as well as the pricing and structuring trends that is ongoing. We will then focus on the wave of credit downgrades, despite a resilience from a default perspective of the securitized CRE loans. We'll then present, during a couple of charts and a couple of slides, the peer comparison among the different CMBS issued in 2021 versus peers, i.e. pre-21, or among themselves. And finally, we'll present the credit enhancement again through a peer comparison. This presentation is complement from a two-part series research that we recently published, and that is available publicly and for free on our website, as well as at the end of this presentation, on the last slide, where you have hyperlinks to all the recent publication related to real estate by Scope Ratings. So moving to the first slide, what we did is we looked at all the CMBS publicly issued since 2018, i.e. 46 CMBSs, and we analyzed them based on their initial metrics, ratings, and characteristics. So the first element to notice is at that cutoff June 21, 10 CMBSs have been issued for 3 billion equivalent euro. This has to be compared to 2020, where 2.5 billion for the full year and 7 CMBSs were issued. So we are currently on track to reach the best years, which is 2019 with 5.3 billion and 16 CMBSs. Since the June cutoff date, an additional CMBS has been issued, Taurus number 4 for this year. So what we see in terms of asset classes and jurisdiction is an internationalization of this business or asset class that was historically pretty UK-centric. Over the last 4 years, almost one CMBS out of 2 was issued from the UK, based on securitized by UK assets. Pre-COVID, Most of the CMBS issued were procyclic assets, so from hotels and retails. Post-COVID, we see the many logistics CMBSs as well as some residential like Sage, which is a UK affordable housing CMBS, or office CMBSs that have, let's say, either secondary assets being secured, either non-prime assets. So what is interesting to note is that the first Spanish CMBS has been issued with Taurus SP number 2, but also many logistics pan-European CMBSs, because the asset class is seen more and more as an international asset class rather than on a country-per-country type of strategy. Despite this internationalization of the market, there is still a type of oligopoly around the arrangers, with the three lead arrangers, i.e. Bank of America, Morgan Stanley, and Goldman Sachs, capturing 2/3 of the issuance. In terms of sponsoring, Blackstone has sponsored 1 out of 2 of the CMBSs since 2018. The rest is split between multi-sponsor, multi-arrangers, which represent roughly 18 to 20% of the total market share. This oligopoly, or this domination of US arrangers and US sponsors, have consequences in terms of the underwriting standards and criteria that we are going to see the next slide. In terms of forecasts, we expect, as I previously said, 2021 level to reach in number of deals, 2019, potentially also in terms of volume. We expect logistics to continue to be issued and some residential CMBS to come to the markets, either through the same type as Sage, so affordable housing, or even UK buy to rent, given the high activity in this space at the moment. So why is this market attractive for all counterparties in the CMBS space, i.e. arrangers, investors, and sponsors? Firstly, for investors in CMBS notes, it presents a premium versus other ABS transactions for equivalent rating. So in average, a AAA CMBS note yield at 100 bips versus 45, 50 bips for other ABS, whereas the BBB is around 300 bips versus 100, 150 bips for consumer or other ABS. It also have advantages because there is no regulatory constraint for this investor versus direct lending. For the arrangers, it represents an alternative source to syndication that was a market relatively mute during the COVID. It also represents a cheaper source of refinancing because the premium that you see here, this horizontal line, which is the premium between the cost of the securitized CRE loans and the cost of CMBS, has been increasing. It reached 1.7% in 2021. This premium is also of interest for the borrowers because so far this premium was captured by the arranger through the issuance of the class, what we call the class X. Nowadays, we see the introduction of a new mechanism called the weighted average margin note. What it is, it's basically the sponsor accepts to take the pricing risk, i.e. the pricing on its loan is going to mimic the pricing of the CMBS notes. Finally, we see an interesting decorrelation between ratings and pricing. while in 2018, for example, the rating of AAA were yielding around A to 1.8% for the most risky assets. In 2021, we see some discrepancy even higher, especially between industrial and office. And this is even more true when we go down the capital stack, for example, for the triple B tranches. In terms of structuring, this activity of US arrangers and US sponsors brings some US underwriting standards to Europe. Firstly, what we call cov-lite CMBS, i.e. CMBS that have as securities CRE loans that don't have financial default covenants prior to a permitted change of control, are increasing and represent now almost 50% of all the loans securitized. This is mainly due to Blackstone that, as part of all its loans, don't have financial default covenants. What does it mean in terms of credit risk? It means that the sponsor has more control over its loans and the stress scenarios, and has longer time and more flexibility to work out these loans. On the reverse, the lenders have less control and negotiation power to restructure the loans. Secondly, the agency CMBS that are this kind of one loan, one borrower, or what we call in the US SASB, single asset, single borrower, are expected to continue to represent the majority of issuances, because the European market is fragmented, both in terms of currency and real estate laws. Therefore, we expect these SRT CMBSs on large portfolios like Red 2 or Griffin Funding Limited that hit the market 2-3 years ago to remain exceptions. The modified pro rata priority of payment, where the sequential trigger is only hit upon some conditions, is also something that became the norm. That creates more volatility in terms of recovery for the senior notes, and we expect this to continue to be the case. On the securitization of structured loan, i.e. senior mezzanine loans where the senior portion is securitized, the trend remains constant, i.e. one out of two CMBS being securitized by such loans. This, from a credit perspective, implies further or more challenging legal analysis, because all the control right mechanisms for any major decisions need to be thoroughly reviewed. Finally, on a rumor in the market speaks about the first European CRE CLO. We expect this to come to life within the next 6 to 12 months. The reason is regulated banks ran away from bridge financing due to the high regulatory capital burden, and private equity firms stepped in. Therefore, large private equity firms nowadays have large portfolios of transitional loans, i.e. non-stabilized or under redevelopment, that need to be refinanced. And CRE CLOs provide alternative and more competitive solutions to warehouse lines, both in terms of advance rate and cost of funding. Now we are going to cover, on the rating side, the impact of COVID. What we did is we tracked all rating actions from all US agencies, i.e. S&P, DBRS, Kroll, Moody's, and Fitch, since the outbreak in 2020 in Europe. We averaged all the rating actions and came up with these charts. So what does it represent and what does it mean? Let's say that one agency downgraded a transaction by 2 notches versus the other one by 4 notches. Therefore, we average to 3 notches. So what we found out is that in total, 93 downgrades occurred in the CMBS space in Europe for 0.5 upgrades, i.e. one agency that upgraded one transaction by one notch versus the other secondary agency that didn't upgrade. This is in contrast to two things. First, the SF instruments are generally upgraded over time because the remaining tenor reduce the uncertainty and some deleveraging occurs. And secondly, since COVID, only one loan has been turned into special servicing as a special service loan. So in terms of asset classes, out of this third of CMBS being downgraded, 75% of the retail CMBS have been downgraded, and all hospitality CMBS have been downgraded. The only upgrade is Pembroke, that has been upgraded by half a notch. And this is a peculiar CMBS that is securitized by more than 100 loans. And therefore, due to collateral repayment, the CMBS has been deleveraging, which is in contrast to usual single loan CMBS that upon deleveraging will repay the loan. So if we look at these downgrades in more details, what do we see is that some CMBSs have been downgraded through the entire capital stack by a number of notches, from 2 to 6.5, i.e. 7 for one agency, 6 for the other. For Elizabeth, a UK CMBS backed by shopping centers, or even Decoram that saw its two main tranches or senior tranches being downgraded by 6 and 7 notches. There is for us two consequences or two takes away from this. The first one is that some of these ratings or initial ratings were, from our point of view, too high because some risks were underestimated, especially in the retail sector, where the change due to the e-commerce has been underestimated, both in terms of the speed of the change and the magnitude of the change. Secondly, for the hospitality sector, the volatility of the cash flows has also been underestimated. Secondly, we believe there is a lack of discrimination in terms of rating downgrades post COVID, especially for the over-collateralized tranches. And this comes from two things from our perspective. One is US rating agencies were criticized after the GFC to have reacted too late. We believe they have probably reacted too quickly and to overreacted also this time. Secondly, the fact to have some ratings based on first dollar loss versus expected loss rating underestimate or undervalue recovery expectations. And this is why you see that 22% of AAA and 30% of AA categories have been downgraded, which is actually pretty similar to other rating category, which is counterintuitive given that AAA and AA categories are expected to remain stable. Moving to the next slides. Here, and from this slide to the next 2 or 3 ones, we do a peer comparison using box and whisker plots, where we present upper and lower extreme whiskers, median, upper and lower quartile. So here we present the key CRE metrics, i.e. LTV, ICR, and debt yield ratios per the initial rating category and asset type. Here we focus on the rating category, and the next one will be on the asset type. What do we see first is that overall the ratios have tightened or year on year versus 2020, with the LTV being around 62% for the securitized loans, 2.2 times ICR and 8% debt yield. However, this remains within the range of historic values. Interestingly, we notice that the debt yield has reduced significantly for AAA and BBB tranches from 16 and 22%, to 16 and 12% from 22 and 12%. Then on a deal per deal basis, 2 or 3 deals we would like to highlight. First, Agora, which is the first and unique retail CMBS that came to the market. This is a CMBS from Brookfield, backed by 9 retail warehouses in the UK with a top tenant around 8% of gross rental income and a 52% LTV. Given the gloomy outlook and performance of the retail sectors, this deal is an interesting deal because it shows that a CMBS at the right level in terms of leverage can have a success in terms of going live to the market. Also, it's important to notice that the debt yield of this deal is really high for the Class A, with 30% loan to value, more than 25% debt yield, and 8 times ICR. On the other side of the spectrum, a deal like Viridis, which is a prime London office space with 30% of vacancy following the departure of WeWork, has really low cash flow metrics compared to peers. As an example, the Class A, it's coming, has like 7.5% debt yield and 3 times ICR, which is pretty low compared to peers. And a more interesting one is one that was in the news recently, which is Taurus number 3 in Germany. It's backed by an asset in Frankfurt, which is a mixed-use asset composed of an office space, mainly let to KPMG pre-COVID, and hotel. This deal has debt yield as a debt yield level, which is relatively low, with the BBB tranches being around 6%. So this shows a refinancing risk to these deals if the cash flow metrics were to remain stable or even to decrease, and if in the same time reference rate were to increase. Now, the same type of analysis, but on the asset type level. So here, a couple of key takeaways. Firstly, there is an opposite trend between retail and industrial, as we have seen in the private CRE market, with Agora that we previously talked about, which is yielding in terms of leverage, but also in terms of cash flows at really historic extreme levels. So with LTV at 51% on the total issuance. In the other side of the spectrum, deals like last mile logistics, which is a CMBS backed by securities, logistic securities, is highly leveraged around 67%, sorry. To this 67% leverage, it is important to notice that recent CMBS backed by logistics assets have a premium to their portfolio valuations, i.e. the portfolio value is higher than the sum of the individual assets composing this portfolio, and therefore it automatically decrease the LTV. What does it mean? Is that there is an attractive premium or an extra premium for selling portfolio of logistics, which is fine. However, in case of workout and in case of disposal of these assets during a special servicing, these assets may be sold on a asset per asset basis, and this premium disappear. Other deals that is interesting here is Taurus 2 SP, that is a Spanish office portfolio in Madrid with secondary assets. As you can see, it has pretty low ICR and debt yield metrics, around 2 or 1.8 times ICR and below 8% debt yield. That could be a CMBS at risk, again, if the tendency was to sour, or the credit profile was going to sour in terms of cash flow metrics, or if inflation and reference rate were to increase. Finally, looking at the last office that we previously discussed about, which is Taurus 21.3 DU, which is this CMBS backed by office in Frankfurt. Again, it has a really low debt yield level, below 7%, and ICR of the more junior class, i.e. for the full vertical tranche, below 1 to around 1.8. Again, this is a deal that could be at risk of downgrade if the performance of the office sector, and especially of this deal, were to continue to be under pressure. We expect the office sector to be exposed to a K-shape, i.e. differentiation between CMBS backed by prime offices versus secondary location offices, or even between CMBS with a tenancy profile exposed to industries that can go completely remote into a remote work strategy like consultancy. We also expect this structuring optical, I would say, optical structuring elements like this this premium to the portfolio valuation to continue to flow into the market. So on these slides, we presented all the deals that have been issued, again, post 2021 versus pre 2021, that are in gray, based on a quadrant basis, where we compare ICR and LTV on the left side and ICR and debt yield on the right side. The cross between the axes are at a 60% LTV, 2.5 times ICR, and 8% debt yield. So to present them in terms of quadrant as an analogy to the BCG matrix, if you look at what I would call the cash core, i.e. the low term and refinancing risk, we have Agora that we discussed previously. We also have Bruegel here, which has pretty high debt yield and ICR versus a relatively limited leverage. On the deals that are low yielding with non-stabilized asset that we previously covered, and that could be at risk of term or default risk, we have the office Taurus 2 that we discussed earlier. We have Taurus DU that we also discussed earlier, and Viridis, that is the one exposed to vacancy. Interestingly, in terms of asset type, the industrial CMBSs have higher leverage than historic peers, but cash flow metrics that are within the average. As you can see from these three ones, being more leveraged than previously, but than previous issuances, but cash flow metrics being around the cross of the axis. On the office sector, we see a higher dispersion, with leverage level being relatively around the mean compared to previous issuance like Taurus 20, or even compared to Counter, but low yielding assets with Verities that we already discussed, or Taurus 21 to SP. Moving to the credit enhancements, we performed this analysis for all the CMBS that came to the market since 2018. What do we see? Is that the regression per asset class trends negatively for all the classes, except the AAA class. This is due to two outliers. Firstly, to Together Asset-Backed CMBS, which is an unusual hybrid transaction between an RMBS and a CMBS, which is secured by a pool of more than 1,000 small CRE, UK CRE tickets. And its higher than average diversity offset the fact that this credit instrument is pretty low, especially in the more senior tranches. However, the other outlier is Bruegel, that has credit instruments that are pretty low compared to peers, and could imply higher optimization of the structure. This plus cash flow metrics that are better than peers, as we have seen in the previous slide. Another interesting point is that non-IG credit instruments for some transactions are better than BBB. Is it the case, for example, for the class E of Together Backed securities, or even from other transaction here, like last mile securities class E with 8% credit enhancement, to be compared with other BBB classes like Agora that has no credit enhancement, or the class D that has an 8% credit enhancement. This implies two things, or one main thing. One is that potentially the impact of a higher expected PD is not offset completely by the higher subordination. Another interesting point is that the industrial CMBSs have higher credit enhancement level versus peers, and this provides some comfort compared to the above average leverage that we previously looked at. We expect a further dispersion of credit enhancement between the different CMBS to be issued, especially for niche CMBS that may come, like social housing. We also expect further optimization of the bottom of the capital structure if pricing continue to be attractive for these tranches, and therefore to have more and more BB and BBB rated tranches. So this is almost the end of this webinar. A couple of words on scope ratings. We are active in the series CMBS space for a couple of years already, through all the asset types, through all Europe in terms of jurisdictions. We rate around 4 to 5 billion euro equivalent debt of series CMBS per annum, and we have been active both in single CRE loan, CMBSs, and CRE portfolios. Finally, for the ones that are interested, we publish regular research that is free of charge and publicly available on our website. For the ones that would like to receive the presentation with all the hyperlinks to the different research that have been recently published, please reach out to me, and I will be happy to follow up on this. I will just take another 1 minute to explain the key takeaways for me of this webinar. First, the CMBS market in Europe is growing. It has shown resilience with only one loan being in special servicing since COVID. It has shown internationalization in terms of jurisdictions being covered. It also shows tighter structuring conditions that should not be underestimated if the COVID would impact on the long term some asset classes. And finally, we in Scope Ratings believe that the market is more resilient than the wave of downgrades may suggest.
Good. Okay, Florent, thank you very much for that very detailed and insightful presentation. So we're now going to move to a brief Q&A session now. So those of you who have questions, please feel free to type them into the questions box on the right-hand side of the screen, and we'll do our best to answer them. Flora, if I may, there's a couple of questions I have here. I'm going to go straight in. You talked earlier in the presentation about this Americanization trend. Is this credit negative?
It's a good question. I think this Americanization trend gives more power to sponsors versus lenders. And therefore, it is more key than ever to assess the quality of the sponsors and the incentives. That means understanding their financial capacity, their investment experience, their risk management, their willingness to support the transaction. And therefore, this should become part of the credit risk analysis and the underwriting profile, i.e. in terms of capex, in terms of lease up, etc. And in Scope, our CMBS methodology, for example, cover these elements where we give credit to the quality of the sponsor.
Okay, thank you. You also talked about the downgrade experience among European CMBS. Do you expect further rating downgrades?
Well, I think the wave of downgrades is pretty massive already. However, I won't exclude further downgrades. If, for example, well, once the moratorium and government subsidies will end in some for some asset class or asset types, as well if the restrictions are not lifted soon, because so far lenders have been pretty conciliant to try to find solution with borrowers, but this won't last forever, especially if they don't see any return to, I would say, to normal in terms of performance. And finally, we are seeing the first update of valuations of properties. And given the time lag there is in terms of property valuations, we could see some further impacts here, especially in sectors that may see massive structural changes like the business hospitality sector.
Yes, indeed. Understood. There are a couple of questions that are there as well, Florent. There's one about CRE property recovery types by type. If you can see that one there,
Yeah.
do you want to take that one and perhaps read out
Sure.
the question and perhaps respond?
So, absolutely. So, would you expect a bifurcation in recovery in CRE property types, residential, logistics leading, and retail leisure lagging? Where will you offer? Where will you place office in this distribution? Quick or slow recovery from COVID? So it's a good question. So clearly, residential has been and logistics have been no impacted so far in terms of performance, whereas high streets and shopping centers especially have been impacted, as well as mass tourism leisure and obviously business leisure. I would expect that people are eager to travel again. So the mass tourism leisure sector will rebound, I hope, and I expect pretty quickly as soon as that measures will be lifted. On the office side, I think it's more like a K recovery, as I mentioned, where you will see prime offices with the right tenancy and the right sponsor behind being recover quickly and adapt to the new situation with a mix of working from home and flex office, etc. Whereas secondary offices or offices for which the tenancy could go to complete remote work will be impacted and may have difficulties to relet.
Okay, then there's a question also, Florent, about debt yields. So let me read this, if you're okay to answer. The question is this: how do you deal with increasingly low debt yields for prime assets and methodologies based on historical data? Does it mean CMBS are only viable for secondary assets?
This is a good question, and I think I recognize somebody who was working on the rating agency side. So in scope, how we approach this? Well, firstly, why the DPS are lower than previously? Just because the macro environment has negative rates or zero rates on reference rates, and therefore yields are tightening. From a scope perspective, the refinancing rate of secured series loans is assessed based on the exit debt yield of these series loans versus an all-in refinancing rate. This all-in refinancing rate is based on the cost of funding for the lender plus a regulatory premium plus kind of credit risk premium and the reference and the underlying reference rate. So we, unlike other agencies, we don't believe or we don't stress our reference rate to levels, I would say, pre-GFC with 6-7% reference rate base. And therefore, what we do is we have a reference rate that is more commensurate with, I would say, the new norm. And therefore, the all-in refinancing rate we expect are lower than the ones previously expected, i.e. 10 years ago. Secondly, our all-in refinancing rate is function of the loan to value of the securitized loans. And therefore, lower is the leverage, lower will be the expected or the required all-in refinancing rate. If on these different questions you would like to have follow-ups, don't hesitate to reach out to me. You have my email address on this slide. You also have Mike Mackenzie, who is the head of structured finance and project finance in the business development side, if you would like to discuss about commercials. Finally, one point that I didn't mention here is you have the link to our methodology that is on call for comment following an update, and that will be turned to final by the end of August.
Okay, sorry, there is one more question I'd like to put to you, which is more like, I guess, you kind of covered it in your presentation, but perhaps you can just do a summary of what you said.
Sure.
What are the main CMBS credit risks at the moment?
So if I look on the liability side, on the structuring side, because I think on the asset side we kind of mostly covered it.
Yeah.
Even though on the asset side, I will reiterate that the above average leverage and this premium to portfolio valuation is an element to not underestimate. On the liability side, there is some elements in terms of optimization of the structure that raise question. I don't think it's bad because it shows sophistication and more sophisticated investors arrangers and sponsors, which is not bad as per se. However, they need to be carefully understood and reviewed. One of them is these cov-like structures that we previously discussed, and the lack of standardization around them, because we have noticed, for example, that some CMBSs had an absence of event of default until of change of control of the sponsors. But if the sponsor was the asset manager, and if this sponsor as asset manager was leaving the transaction, it was not triggering an event of, change of control. The same happens with the application of voluntary partial prepayment that we have seen in some deals was allocated in the waterfall in reverse sequential order, i.e. deleveraging the most junior notes. Finally, we have also seen some CMBSs where there were an absence of premium for a release price of assets, and therefore lower reduction of the granularity of the portfolio was not triggering a deleveraging of the liability side.
Right, thank you very much. We're out of questions now, Florent, so thank you so much for getting to answer those. So in the absence of further questions, let's quickly put up the download or the feedback form. So if you could, before you disappear, just quickly click on that. It will take literally seconds to fill in. And while you're doing that, let me thank you, those of you who dialed in, for doing so. I hope you found that insightful. As Florent says, do reach out if you have further questions. His email address is on the screen now. And check out the website as well for specifically the two latest CMBS reports that Florent has authored, which I think you'll find you can download and have a read. So as Laura mentioned, CMBS is one of the core strengths of Scope Ratings. So we'll be back for more in this format, either in the form of a market update, market outlook, or potentially in terms of future rated transactions as appropriate. So do stay tuned. Enjoy the rest of your days, stay safe, and we'll be back for more soon. So for us, it's goodbye.
Thank you. Bye-bye.